Chapter 11 of Financial Accounting, we talk about corporations and different stock transactions, and those stock transactions end up in the stockholders' equity section of the balance sheet. So this first objective talks about the characteristics. So again, it's a publicly held company, and it's normally going to be for profit. So there can be some large not-for-profits that are listed here, but normally when we're working on these types of problems in financial accounting, it's big publicly traded companies that are for profit, such as the ones that are listed here. The advantages and disadvantages, which we'll get into in detail on the future slides, are listed here. So you can see, we've got several different advantages, again, that we'll talk about individually. Then there's one that crosses over, so there could be some advantages to it as well as disadvantages, and then a couple other disadvantages. But you can see by far the advantages are more than the disadvantages, which is why so many companies do choose to become incorporated. So now we'll talk individually about those. So they have a separate legal existence, which means they can enter into contracts under their own name. And if the owner, say the person who owns the majority shares of stock dies, it doesn't impact the corporation, so that's also going to come down into our continuous life. But so the corporation has its own separate legal existence that isn't tied specifically to any individual stockholder. Then we talk about limited liability. That means it's limited to their investments. So if you had some money and you wanted to invest it, and say you go out and buy some shares of Amazon stock, well, whatever you invested, so say you've got $10,000 invested, if Amazon were to go under and declare bankruptcy, you could lose that $10,000, but nothing else. So say you're Jeff Bozy, or whatever his last name is, the founder of Amazon. Now, he would have a ton of Amazon stock, so his investment would actually be very, very large. But say he did something wrong and the company was being sued, all of his net assets are not at risk. The only thing that is at risk is those shares of stock that he would own in Amazon. So again, if you try to think about it as maybe a smaller business, it makes your personal assets safe. The only thing that's up for grabs is the money that you have invested in that company. And then the next one is transferable ownership rights. So again, at any point you could sell. So again, say you have that $10,000 of Amazon stock and you think, well, as soon as it gets up to $12,000 in value, I'm going to sell. So then that's your goal. You go ahead and sell it. You made $2,000. It transfers to the next person, and you're out. So it's very easy to do. It's all publicly traded. It's all out in the market. Then the next one is the ability to acquire capital. So again, companies are looking for ways to finance their growth, or if they want to expand and get bigger. So they could borrow money, or they can issue shares of stock. And then that's what this whole chapter is going to talk about. So we've already talked about bonds, which is a way that they borrow money from investors. They could have loans that they borrow money from banks. But then this is a way that they can get money, but it's not borrowed. They're not going to pay it back. They're going to sell shares of ownership in the company, and in exchange they get cash, which they can turn into capital and use that for growth and other long-term investments. Continuous life, like I talked a little bit about up here, it means that it's not impacted by any one stockholder, an employee, or an officer. So even if the president of that company were to die, the company continues to exist. They would have to replace him. Even if the majority stockholder died, again, the stock would get aired out to his heirs, and you would just have new owners. So it could change the company, but the company continues to exist as a legal entity. Okay, then we have our corporation management. So we had this as an advantage and as a disadvantage. So the advantage is that you'll have a board of directors who are going to know your business fluently, and then they're going to supervise the managers, which again you would hire, hopefully the best and the brightest, so you can have all kinds of skill and experience coming into that business. So that would be an advantage, I believe. But I guess if the management had ulterior motives and maybe they wanted to, um, you know, try different things with the company for personal gain, then that could be where the disadvantage could come in as well. And then there's all kind that we skip government regulations, but that's a disadvantage because corporations are obviously going to be subject to any of the laws and the environmental, you know, agencies that are out there, and your like workers' compensation agencies and um, all of those kind of like your OSHA standards and all those things. Then the last one here is your taxed twice. So what you'll hear about a corporation is that there's double taxation. And there is because the corporation has to file its own tax return and then pay income tax at the corporate rate. Then when they pay out dividends to their stockholders or their owners, those stockholders and owners are also taxed on those cash dividends. So really it's the same income. So the government gets it when the corporation pays, and then they'll get another cut when the corporation gives it to the stockholders. Here's a sample organizational chart. So like I mentioned, when I talked about the management expertise, you'll have a board of directors who kind of make the big picture decisions for the corporation. And then you'll have this level of management tiers, these VPs or these vice presidents. And these are people, again, that could come and go. The board of directors will also rotate on and off, depending on the years. And of course, your president could come and go as well. But so then you can see the different, level of authority in those. So how do we form a corporation? So we realize that the advantages outweigh the disadvantages, and so many big businesses are corporations. So they file an application in the specific state that they want to. So again, it could be the state that they operate in. So say you're not a huge corporation and you're in Ohio, your chances are going to file in Ohio. If you're a worldwide corporation, you're probably going to incorporate in either Delaware or New Jersey because they have favorable state laws that favor corporations if you were ever to get into a lawsuit. And then if they are in interstate commerce, which means they're, not just in one state, but they're doing business across multiple states, they would need a license to do business in each one of those states. So what do the rights of the stockholders, the people who own those shares of stocks? They can vote in the election of the board of directors, so they can help to set who's going to be, again, governing the big picture of the company. And then they have a right to share in the earnings of that corporation through dividends. Dividends are never guaranteed, but that's many companies will pay them, assuming they're profitable and they have the cash. We have this preemptive right that is not, the stock could be issued that way, where the person means that if they have, say, a decent share ownership, so like in this example, this individual has 14% of all the shares outstanding. If the company then decides to issue out more shares, she still wants to have her 14%. So she would have to purchase those shares, but she has the preemptive right, which means she gets to do it first. So she could buy whatever shares are needed for her to maintain her 14%. And if it was a family company like I think Walmart still is owned a lot by the Walton family. And then like here locally, we had Shears who they've gone private now though. But when they were public, again, the Shears family was very involved, so they would have wanted to have a majority interest, and they would have wanted to maintain it. So those are the type of people who care about that preemptive right. And then you finally have a residual claim on the assets. You're at if you're a stockholder, you're the last man on the totem pole though. So first of all, all of the creditors, so anyone you've bought inventory from or any of that stuff, they need to get paid. Then the bank loans and the bondholders, anyone who you've borrowed money from. Then if there's anything left after that, then the stockholders would get it. But again, like we only worry about that if the company is declaring bankruptcy and going out of business. So then we get into this different terminology. So, and if you were looking on a balance sheet of a publicly traded company, you would see like these different words. So authorized stock means they have filed with the Securities and Exchange Commission, and they are allowed to sell the maximum number of shares. They can always go back and get that increased, but I think it's a lot of legal work and accounting work, so it's good to get as many shares as you could when they're first filing. So that's how many they're allowed to sell, the authorized. Then they're going to go ahead and start issuing those, start selling them. So they could sell directly to investors, or it could all be done indirectly through the different broker houses. They could be put into mutual funds and things like that. So now if it's a brand new startup, you don't always know for sure what that selling price is going to be. So these are some things that can impact the selling price. Their anticipated future earnings. Are they a very profitable company? How much do we expect them to pay out in dividends? Are they currently doing great and have a ton of assets and not a lot of debt? Is the economy in a boom, or is it kind of in a recession? And then what other things are happening in that market? So like what would a comparable stock be selling for? So all these things impact the company, and some of these things are out of the company's control. So again, if you study the financial markets, you know that a lot of things can impact them. Then you want to understand from an accounting standpoint that stock is issued at either par value or no par value. So the most common I feel like is a par value. So it might just be $1 par, it could be $10 par value. It's normally not going to be a real high value. And states do not require it, but I do feel like most companies have a par value. Now it says that no par value stock is getting more common in today's market. But again, some of these companies have been around for years and years. So I feel like most of the companies you kind of look at do have a par value. But if they do have a no par value, then there's normally a stated value that's assigned by the board of directors. So then now we'll kind of get into actually the accounting entries for issuing these shares of stock. Now what happens is, and we'll talk about this paid in capital. So this paid in capital can be abbreviated PIC, so you may see that in the textbook or in problems, and you can even abbreviate it that way if you were writing it. And then you want to know the difference between the different paid in capital accounts and retained earnings. So here we'll have some examples. So we have this Hydro slide issues 1,000 shares of $1 par value stock. So then first of all, what's their entry if they actually sold it for $1? So they would receive the cash, 1,000 shares times $1 would give them $1,000, and they would credit common stock. So that's showing that those shares of stock are now issued. Now, chances are they're going to sell it for more than the par value. So let's say they are issued them out at $5. So then now they'll receive $5,000, $5 times 1,000 shares. We still only put the par value to the common stock account, and then anything over par value goes to the paid in capital in excess of par. Again, so you could abbreviate that PIC. And then there's a dash common stock, because we'll see they can also have preferred stock, and we like to keep those separate. And there could be actually even be treasury stock, and we like to keep those all separate. So in this case, it'll say dash common stock. So here we have a little snippet of the balance sheet that shows that equity section. So we've got the common stock issued at our par value, and then the paid in capital in excess of par dash common stock. So our total is going to be the $6,000. And then that's added into our retained earnings to get to our total stockholders' equity. All right, now we have the no par stock. So say it's got a $5 stated value and they issue 5,000 shares at $8. So we really do it the same as if it was a par value. So we take the $5 stated value times the 5,000 shares, and that's what goes into our common stock account. Our cash is the 5,000 shares times the $8 per share. So we're getting $40,000. And then anything over the 25,000 goes to the paid-in capital in excess of stated value versus par value dash common stock. Okay, now what if it doesn't have a stated value? Then it's just all going to go to the common stock. We will have no additional paid-in capital account if there's not a stated value. All right, then sometimes companies can issue shares of stock for things. So maybe they can, if they have attorneys or consultants that are helping them start up, a lot of times they can give them shares of stock instead of paying cash. Sometimes in deals to purchase land or buildings or other long-term assets, they could, work a deal out with a person to take shares of stock instead of cash. So if that's the case, we have to value them at the fair value of the what they've received, or what was given up, whichever's more clearly determinable. So here we have an example. So they have $5 par value stock. It's actively traded at $8 per share. They issue $10,000 to acquire land that was advertised for sale at $90,000. So we're going to value it at the $8 because that is more reliable. I mean, right now it's advertised for sale at 90 doesn't mean that that's what they're going to get. That just means that's what their list price is. So we're going to go with the $8 per share times the 10,000 share and value our land at that $80,000. Our common stock is the 10,000 shares at the par value of $5, and then the excess goes to that paid-in capital. Okay, then we get into our preferred stock. So companies, if they're publicly traded, they have to have common stock. They do not have to have preferred stock. It's a choice. Again, it's another way for them to raise capital. So they may or may not have it. But if they do have it, the preferred stockholders have priority in the dividends. So they will always get their dividends first. And as we talk about it, we're going to see that if they're cumulative dividends, they may have to get caught up on years that they were not paid dividends before any common stockholders get it. And if the company were going bankrupt and the assets are being distributed, again, like I said, the common stockholders are last man on the list. The preferred stockholders come above them. So they would get their money before the common stockholders. But our accounting transactions are very similar. So here we have 10,000 shares of $10 par value preferred stock that they sold for $12 a share. So our 10,000 shares times our $12 is where we get the cash amount. To the preferred stock, it's only the par value, so 10,000 shares times $10. And then anything in excess of that goes to paid-in capital in excess of par, but now you can see it's dash preferred stock. So again, it's just a separate account that shows it's related to preferred stock and not common stock. All right, then we get into treasury stock. And again, treasury stock is something that is going to be up to the companies. So it's when the shares are issued and outstanding and the company decides to buy some of those shares back. So they'll go out into that open market and they will buy some of their own shares, and then they don't retire them completely. They hold them in the treasury, which is why they're called treasury stock. So then you might think, well, why do companies do that? So there's several reasons. If the company gives stock options, I worked at an oil and gas company, and we would get stock options every February. So if they want to give shares of stock to their employees or for the stock options were the right to purchase the shares of stock at a specific price. So they want to have those shares of stock set aside and available to the employees to purchase. So that would be one reason to do it. If they felt like the other thing that happened at the oil and gas company, we made a bad acquisition and our stock price went from about $15 a share down to $2.43 a share, I think, or $1.43. It got really low though, around $2 a share. So at that point in time, it was way undervalued. Our president and our board of directors said, we believe in this company enough that we're going to go back out in that market and we're going to buy those shares at that $1.43, and because we believe in ourselves enough to do it. So we did. So any available cash we had, we went out, we bought those shares of stock back. And in time, we would have sold them back out when it came back up to a regular value. But initially, we were just buying them and keeping them in our treasury. If they thought we were going to have to use them to acquire another company or maybe to, to buy a big long-term asset, we may want those additional shares. And if we take them off of the outstanding shares, so they're issued, but they're no longer outstanding because we've bought them back, mathematically that will increase our earnings per share because our shares outstanding goes down. And if our earnings remain constant, that earnings per share number goes up. So again, there could be a variety of reasons that businesses do it. And generally, they're going to use the cost method, which means we debit the treasury stock account for the price that we pay. Because again, we're out in the market buying it. The treasury stock is a contra stockholders equity account. So again, think of what a contra account is. It means it's an opposite direction. So stockholders equity is normally a credit. This is going to be a debit. And there are no dividends because, they're not going to pay dividends back to ourselves. And obviously, we can't vote. The company itself can't vote on those issues. So here is a journal entry. So we've got on February 1st, they acquire 4,000 shares at $8 a share. So we debit treasury stock, 4,000 times the $8 is $32,000, and we credit cash. So then now, as we put that into our balance sheet, we see again, it's in red. We're subtracting that. It's a contra account. It's reducing our equity. Now then, say a couple years later or a year later or whatever, we decide, so for our example, that oil and gas company, when the stock price went down to that $1.43, say it goes back up to $10. Well, we might think, okay, now's the time, let's sell it back out. Because we're not going to hold it forever. So then we'll have two different scenarios. Well, what if we sell it above cost? What if we sell it below cost? So here we have, they sell it for $10 a share. They had acquired it at $8, but now they're selling it for $10 a share. So they receive cash, $10 per share, 1,000 shares. They receive $10,000. We need to take it out of the treasury stock at what we put it in at. Again, because we want all of our accounts to balance. So we can't reduce it at a cost that's more than what we paid. So we take the $1,000 out at that $8 we paid, and then we can't. So we have, in a sense, if you're following this, we've got a $2,000 gain, right? We made $2 a share and we sold $1,000. Well, we can't. GAAP does not allow us to record a gain on that sale because it's our own stock. So we can't make money on ourselves. So what we are forced to do, following our generally accepted accounting principles, is credit paid in capital, and then now this is going to be treasury stock. So again, we've had three different types of paid in capital, and then this one distinguishes it from. Okay, then we have now, what if we now sell some below? So again, we bought these shares back at $8 a share. What if we sell them at $7? So now we have 800 shares that are at $7 a share. We receive that cash. We've got to take them out of our treasury account at the $8 that we paid, again, because we want this treasury stock account to balance properly. So then, in a sense, we lost money, right? We lost $1 a share. But GAAP says the same thing. We can't record a loss on selling our own shares of stock. So we're going to reduce that paid in capital treasury stock. And in this case, we have a balance in there that we can reduce it. So then here now, what's left, we have the 2,200 shares left, and we again sell them at a loss. So we're selling them at $7 a share. We paid $8. So then now, though, let me flip back here real quick. Once we've sold these, all that's left in this paid in capital treasury account is $1,200. So as we look at this entry, that's the most we can take out. We can't let this paid in capital account become a debit balance. So we can only use up what's in there. So we've used up what's in there, and there's still an additional loss. And again, I'm using air quotations when I say that, because again, we can't record a true loss, But what we'll take it then to is the only account that's left in our equity section is our retained earnings. So if we go beyond what's in the paid-in capital from the treasury stock and we've sold it for less than we paid, then we're going to debit retained earnings or reduce retained earnings. All right, then we get into our next category of equity transactions, and those are cash dividends, stock dividends, and stock splits. So I mean, there could be property dividends. I mean, they could pay out in the form of some sort of property, but we're not really going to focus on those. More the cash dividends and then the stock dividends. So in order for the company to pay out cash dividends, they have to have retained earnings, meaning they had to have net income. They have to have adequate cash to be able to pay it out, and the board of directors has to approve it or declare it. So then here just kind of shows you some dates. So maybe the board of directors will meet on December 1st, and they'll say all shareholders of record on December 22nd will get paid dividends, and we will pay those on January 20th. So that on December 1st, when we declare it, we're going to debit cash dividends and credit a dividends payable because we know we owe. The date of record is just identifying the shareholders who are going to get paid. So it doesn't increase our liability or change our liability, so no entry is required. Then when we actually pay those shareholders, we will debit the dividends payable and reduce our cash. Then, as I mentioned with preferred stock, preferred stocks can be cumulative. If they are cumulative, that means that the preferred stockholders should get paid their specified dividends every single year. And if the company does not pay, if they pass on dividends and don't pay for a year, they will owe those preferred stockholders whenever they do pay. So those preferred stockholders will get their current year dividends and then any unpaid prior years before the common stockholders get anything. So here's an example. If this company has 5,000 shares of 7% $100 par value cumulative preferred stock, each $100 share pays a $7 dividend. So the 7% times the par value is where that $7 come in. There's 5,000 shares, so the annual dividend is $35,000. If the dividends are 2 years in arrears, meaning they haven't paid for the past 2 years, they owe those shareholders $70,000, plus they owe them their current year. So $105,000 is how much is owed to the preferred stockholders. So they have to get paid first. So here we have another example. If they have 1,000 shares of 8% $100 par value preferred stock, and they have 50,000 shares of $10 par value common stock, if they only can afford to pay a $6,000 cash dividend, they'll record the cash dividend, set up the dividends payable, and then because these dividends are the preferred stockholders, they're going to get theirs first. So there's 1,000 shares times $100 par times the 8%, so it's $8 a share. They owe them $8,000. So in that case, they're going to get all of those cash dividends. The common stockholders aren't going to get anything. And then there's still a little bit in arrears. So even next year, the preferred stockholders will get the remaining of their $2,000 and then whatever else the company can afford to pay. All right, so then here we see if they have a $50,000 cash dividend, so now all of a sudden they're paying a lot more, they're going to catch up what's in arrears, they're going to pay the current year dividend, and then anything remaining is going to go to the common stockholders. But again, we see the same entry. It still goes to cash dividends and dividends payable. Doesn't matter in our journal entry if it's going to the common stockholders or the preferred stockholders. Now, what if the company doesn't have the cash? Then they may choose to issue stock dividends. So that's the number one reason why they might do it, is they can still give stockholders dividends without using up available cash. They may also want to increase the marketability of the corporation's common stock. So what happens when you issue a stock dividend is the price goes down a little bit. So that would make, again, a lot of times they think that'll bring a market because the price is going down. And I feel like those are actually the two most common. If it's a small stock dividend that's less than 20 to 25%, a large stock dividend is more than 20 to 25%, and we're going to see that almost becomes like a stock split. So here we have a 10% stock dividend on 50,000 shares of $10 par value common stock. The market value is $15 a share. So we're going to debit stock dividends at our 50,000 shares times 10% times the current market value. So that's worth $75,000. We're going to credit an account called Common Stock Dividends Distributable for the dividend amount, right? Yeah, because it's 10% times the 50,000 times the $10 par value. So that's that 50,000. And then the remainder goes to paid in capital in excess of par common stock. Now here we have basically the same thing, right? It's just showing us then when they pay it. So now when they pay that out, they're going to debit the common stock dividends distributable. And again, it's not going to credit cash. It's going to be in additional shares of stock. So the common stock. So here it kind of shows you before the dividend, what did the stockholders' equity account look like, and then after the dividend. So then you can see the total value doesn't change. All that changes is the shares outstanding. Our par value also doesn't change either. What would change is the market value of that stock. It's going to go down by the amount of the stock dividend. So it would decrease by the 10%. So it's really just shifting between line items. So because now there's more shares outstanding, our common stock is going up. And then our retained earnings is going down because we're giving the dividends out to the shareholders, and the dividends paid decreases our retained earnings. Okay, then stock splits. Companies will do this if their stock price gets too high. So then they may choose to do it to bring that price down. So it's actually that I feel like that's probably the most common one. It does increase their number of shares outstanding, which will ultimately decrease their earnings per share. So that's not always a good thing. Or it will give additional shares to the stockholders. I mean, if that's what you were hoping to do. But I feel like the most practical reason companies do it is to reduce their market value. So if you had 10 shares, and in this case, it's a 4-for-1 split. So if I had 10 shares, now I have 4-for-1, I'm going to end up with 40 shares. And like this guy saying I had 40 before, a 4-for-1 split, now I have 160 shares. But as you look at his total of the company, it stays the same. That block represents how much he owns. It doesn't change. It's just the number of shares change. And then as we look at our balance sheet, our stockholders' equity also does not change. It stays the same at $800,000. What changes is our number of shares. So now instead of having 50,000 shares, we have 100,000 shares. So our par value is down to $5. It goes in this case, a 2-for-1, it would go in half. Okay, then we get into our final objective where we kind of look at the equity section of the balance sheet and what ratios do we look at. So again, here's a little section of it where we've got our common stock, and in this case, they have a retained earnings that is a deficit. It's not increasing it. They must have had a loss. So it's a debit balance. So things that can impact our retained earnings or our ability to pay out dividends out of those retained earnings our legal restrictions. If the state says you can't, you can't pay out of, you can't make your retained earnings go negative. You can't make your paid in capital go negative. If you have contractual restrictions, like you have a loan and there was debt covenant agreements that say you cannot pay out dividends if your retained earnings are at a certain level, or if the company just makes that choice. So in our equity section of our balance sheet, we're going to have our different stock accounts, our different capital accounts. Again, could be common stock, could be preferred stock, could be treasury stock in there. We'll have our different additional paid in capitals, or our PIC, our PIC accounts. Again, those will be dash preferred stock dash common stock from treasury stock. And then we'll have our retained earnings. So here's kind of a full balance sheet that has a variety of things in it. It has the common stock, the preferred stock, the different levels of paid in capital, and then our treasury stock down here at the bottom. So what ratios? We could do a payout ratio. How much of our dividends are we paying per share? In this case, this would be our total cash dividends divided by our total net income gives us a payout ratio. We could also do that per share of stock if we had that information. The return on common stock equity is another ratio that looks at the net income minus our preferred dividends divided by our average stockholders' equity to say what type of a return are we earning on the money that people invest. So then a lot of times investors are looking at that type of a return. Okay, so that is a lot of things covered in that one chapter, but all kind of funnel into our stockholders' equity of our balance sheet.